Okay, so previously we discussed about Section 40. Okay, that's uh, what I call this, the tax-free exchange. You just remember the last paragraph of this one, the Phil Invest case. This one, uh, paragraph C. No gain or less or loss shall also be recognized if property is transferred to a corporation by a person in exchange for stock or unit. Okay, that should be clear for now, by now. Now on section 41, you just read that it's inventories. Okay, and well, this section 42, you must familiarize yourselves with this because these are the income considered as sources from within the Philippines. Okay, so you must understand the meaning of source of income. Okay, I repeat, it is the property, activity, or what? Service that produce the income. And we'll go to section 43. This is all about the accounting periods and methods of accounting. This is more on the procedural or more on the accounting side of the law. What's that? Accounting side of the law. Yeah. Well, these are the guides in by for the bookkeepers and the accountants to to take into account whenever they record the transactions of the company. I think this one was asked accounting for long-term contracts. You just read this, and also the installment basis. How do you recognize gain whenever there's this long-term contracts, especially those which involve what erection of buildings, construction of buildings, or the hardwares or the well, okay, so bridges, everything. So you have that. And sales of dealers in personal property. You just read this, plus section 48 and 4, and understand that, of course. I want to discuss about section 50 because this is, well, one of the inconspicuous provision. This is what they call sometimes as the transfer pricing. Okay, section 50 is all about the power of the commissioner to allocate income and deductions as the what I call this, the provision states here. In the case of two or more organizations, trades or businesses, whether or not incorporated and whether or not organized in the Philippines, owned or controlled directly or indirectly by the same interests, the commissioner is authorized to distribute a portion or allocate gross income or deductions between or among such organization, trade, or business if he determined that such distribution, apportionment, or allocation is necessary in order to prevent evasion of taxes or clearly to reflect the income of any such organization, trade, or business. A classic example of this is, well, I will not mention the company, but the one who buys fruit from the farmers here. Okay, you remember the Haplasius Owell? Okay, so for example, there's this company A which buys the oil, coconut oil from the farmers. Okay, and this company A will now produce Haplasius oil. Okay, for panghaplas ninyo ba sa inyong mga kagid-kagid. Now, but this Haplasius oil is being exported. Okay, the this Haplasius oil will be exported to a certain company, which is also the holding company of company A. Now, there's this method, what they call the transfer pricing, is that they transfer the price. When you say, for example, they buy the copra from you at say around 5 pesos, okay, and they process that and they just put it in a bottle with Yam Yaman, Moriman, and that's it. And put the brand Haplasius. It's just copra oil, lana. They just put it in the bottle and there you go. They sell that to what? Company A International. they buy the coconut oil or the lana from you at 5 pesos. Okay, just put it in that price. They will sell that to Company A International, or Company A Philippines will sell that to Company A International at 6 pesos. Okay, so maybe, okay, let's peg it at 10 pesos per bottle. So Company A Philippines will sell the Flashes Owel to Company A International at 10 pesos. So they have this margin of 5 pesos, okay, the gross revenue. Now, the Company A International will sell that to the end consumers at, say, for example, 30 pesos per bottle, or equivalent to the peso value here. So obviously, actually, Company A Philippines can export that directly to the distributors in the international market. But that is the method used by corporations to what I call it transfer pricing, because in the Philippines, Company A Philippines just earned 5 pesos per bottle. It could have earned like 25 pesos per bottle. Had it sold that to the international market. It didn't pass through its holding company. But because of this transfer pricing scheme, it would just declare the 5 peso gross revenue, and you less all the direct costs there, and it will leave Company A Philippines just a modicum amount of net income for it to say, oh, we incurred losses for this year because this is that, and this, and this, and this. But Company A, where the international is located, might be in a tax-friendly jurisdiction, such that the tax that they pay there, because obviously they have this bigger margin compared to Company A Philippines, that's actually tax planning. Okay, it's kind of a, I wouldn't say circumvention, but yeah, it really is a circumvention on the payment of the taxes here in the Philippines. So I hope you get a picture. If I can make a, what do you call this, an illustration, I've explained that before to you, but that's it. That's the transfer pricing scheme. The idea here is to declare much lesser income in the Philippines, and the holding company will declare bigger income there where it is located in a tax-friendly jurisdiction. Okay? But the commissioner, according to Section 50, is empowered, this one, to distribute a portion or allocate gross income or deductions, this one. So the commissioner will say, oh, this is just a, what do you call it, a transfer pricing, because obviously the 25 pesos or the 25 pesos, they sell that in the equivalent value of pesos, of 30 pesos in the international market. So that would be the 25 peso margin. The commissioner has the power to do that, to apportion the gross income if it is necessary to prevent evasion of taxes or clearly to reflect the income of any such organization. Okay? So this is section 50, because in the books of Company A class, both companies, Company A International and Company A Philippines, will, in their books, the Company A, the holding parent, the parent company or the holding company, will recognize that the 25 pesos will be imputed to Company A Philippines in the internal books, such that they will, or the Company A International, for purposes of determining the true income of Company A Philippines, will peg or will impute the 25 peso income to Company A in their internal books. But in the books of the public, Company A Philippines only declares 5 peso per bottle margin, okay, on the Haplashes Owel, sold to Company A International. So again, I hope you get the idea there. But there is this jurisprudence. I remember the Phil Invest case. Okay, where's that? This one, FDC, FAI, and FLI. This is the same case about the tax-free exchange, because what FDC uh, do here, or what FDC conducted, or FDC loaned money or advanced so much money to FAI and FLI. And the source document was where this cash vouchers or check vouchers, inter-office memorandum, etc., etc. Now the BIR found that out that, okay, FDC, you're loaning money to FAI, and you're also loaning money to FLI. This is, so what? So what now? Those are my subsidiary. They need money in a period. So as a parent company, as a parent, you support your children. Okay. So, but the BIR said, you don't. Why are they not claiming interest expense, and why are you not claiming also interest income? Well, according to the BIR, under Section 50 of the NIRC, but not really under Section 50, because this was, I think, this case was tackled prior to the 1997. But that's the idea, the apportionment, the power of the commissioner here to apportion income. This one. What the commissioner did was to apportion, or the commissioner imputed theoretical interest, because the commissioner said, you don't just loan money to other corporations without what? Uh, Imposing interest there. So I will impose theoretical interest income on you, because supposedly you should have collected interest from FAI and FLI. So it reached the Supreme Court. The Supreme Court said here, despite the broad parameters provided, however, we find that the CIR's powers of distribution, apportionment, or allocation of gross income and deductions under Section 43, now Section 50, and Section 179 of the Revenue Regulations does not include the power to impute theoretical interest to control taxpayers' transactions. Pursuant to Section 28, now Section 32, after all, the term gross income is understood to mean all income from whatever source derived, including but not limited to the following items: compensation for services, including fees, commissions, and similar items. Gross income derived from business, gains derived from dealings in property, interest, rents, royalties, dividends, annuities, prizes, winnings, pensions, partners, distributive share of the gross income of general professional partnership. While it has been held that the phrase "from whatever source derived" indicates a legislative policy to include all income not expressly exempted within the class of taxable income under our laws, the term income has been variously interpreted to mean cash received or its equivalent, the amount of money coming to a person within a specific time, or something distinct from capital, or principal, or capital. Otherwise stated, there must be proof of the actual, or at the very least, probable receipt or realization by the controlled taxpayer of the item of gross income sought to be distributed, apportioned, or allocated by the CIR. The Supreme Court went on to say that even if we were, therefore, to accord precipitate credulity to the CIR's bare assertion that FDC had deducted substantial interest expense from its gross income, there would still be no factual basis for the imputation of theoretical interest on the subject advances and assess deficiency income taxes thereon. More so, when it is borne in mind that, pursuant to Article 1956 of the Civil Code of the Philippines, no interest shall be due unless it has been expressly stipulated in writing. Considering the taxes being burdens are not to be presumed beyond what the applicable statute expressly and clearly declares, the rule is likewise settled that tax statutes must be construed strictly against the government and liberally in favor of the taxpayer. Accordingly, the general rule of requiring adherence to the letter in construing statutes applies with peculiar strictness to tax laws, and the provisions of a taxing act are not to be extended by implication. While it is true that the taxes are the lifeblood of the government, it has been held that their assessment and collection should be in accordance with law, as any arbitrariness will negate the very reason for government itself. The CIR versus Phil Invest. So what happened here? Well, the Supreme Court disallowed the imputation of theoretical interest because first, there is under Section 50, you are not allowed to expand what is the plain meaning here, right? Because the gross income, as said, it should be what actually received, or at least at the very least should be probably be received, or the actual events test. In this case, the Supreme Court cited Article 1956 of the Civil Code that interest cannot be collected or cannot be considered as due when it is not in writing. What happened in FDC is there are just vouchers, there are just intercorporate memorandum allowing the advances to FAI and FLI, this one. So what they have here is not really a loan contract, but just the documents between two related parties, okay? Just the IOUs. IOU. The Supreme Court said the PIR cannot do that. No, you cannot impose theoretical interest. So you just watch out for this because the examiner might give or might give a question about this, Section 50. If you understand the import of this, then you just have to answer that the commissioner has the power to apportion, to determine, okay, if it is necessary in order to prevent evasion of taxes. So this provision class involves two or more companies that are related, and this is what they call the transfer pricing. This is not really one of those that are well discussed extensively, but this might be asked. Pang one day shocker ang examiner. Okay? So that's about it for Section 50, and we'll discuss Section 50 and the rest of the provisions.